Okay, Golden Gecko options trading. What you need to know, part 3. In part 1, I covered how to bet that the stock will go up. We called that selling a naked put. In part 2, we covered how to bet that the stock will go down, and that's called selling a naked call. In part 3, I want to cover how to do both at the same time, and that's called selling a naked strangle, or selling a strangle. A lot of people, there's some fallacies out there. There's all different types of ways people say you can tell if the stock is going to go up or down and whatnot. Well, the taste you trade concept is pretty much, you pretty much don't know. It's a 50-50 shot either way. So if you don't know if the stock is going to go up, or if you don't know if the stock is going to go down, but you have a pretty good feeling it'll stay within a certain range by a given time, you can bet that as well. And that's called selling a naked strangle, or selling a strangle. And as always, let's use those so you can get a real easy way to comprehend this, and a real visual graphic way so you can see how this looks. Again, log into Doe. You're going to click on trade. Okay, you can type in SPY like I have it out here. And if you type in SPY, I'll just do it so you guys can see, because remember, this is strictly for new beginners. Okay, you're going to choose a strategy. Okay, and let's do a real quick review. What does selling a naked put look like? Go to short put. Go to short put here. Go to advanced. Make sure this is 45 days. 1 standard deviation. Click go. And you're selling a naked put. 1 standard deviation out of the money, which is below the current price. 1 standard deviation below the current stock market price. And again, you have a 89, 84. You should be at least an 84% chance of making money. Okay. The green is where you make money, the red is where you lose money. Okay? So that's selling a naked put. What is selling a naked call? The exact opposite. Go to option, go to click on short call, 45 days to expiration, monthlies. Make sure this is 1 standard deviation. Let's check. Click on go, and here you go. You're going to move this so you have right around that line right here, this blue vertical line. And by selling a call 1 standard deviation out of the money, you're selling a call 1 standard deviation above the current stock price. Okay? And in this case, you're going to have a, like again, you want to be around an 86, 84% chance. That's how you know. Okay? And that means the stock, as long as the stock stays anywhere in this green area, you make money. Anywhere in the red area, you lose money. Okay? So as you can see, selling a naked call is around here, and selling a naked put is above. Selling a naked put is below the current price. Selling a naked call is above the current price. Now, what if you do both? That's called selling a strangle. So here's what you do. You can clear like I did. You type in SPY again up here. You go to choose strategy, and I want you to go down where it says strangle. Okay? You're going to click on strangle. You're going to click where it says short strangle, because remember, you're selling a strangle. You always want to be selling something. Selling short strangle, your default, you want that clicked. 45 days expiration, you want to make sure your monthly is clicked, and you want to click on 1 standard deviation, and you're going to click on go. There you go. I'm going to zoom in a little bit right here. There you go. So you can see here, you're selling a naked put, 1 standard deviation out of the money, which is below the current price, and you're selling a call, 1 standard deviation out of the money, which is above the current price. Now, if you do both, okay, remember, the green is where you make money, the red is where you lose money. As long as the S&P 500, which is currently $197.74, as long as it stays in between $187 and $210. So anything in between, you make money. Okay, anything outside the green, okay, you lose money. Now, okay, and how many days expiration? Well, we have 61 days for this to expire. So at the end of 61 days, is if this green dot or the S&P 500 is within this range, you make money. Now, what are your odds of that? Well, as you can see right here, it actually shows you. That's why anything, see this 1 standard deviation line right here? If you sell something, both the put and the call, it says you have a 68% chance of being right. Okay? So this is a little bit off, a little bit high. I can move it in a little bit. It'll go to the nearest strike, okay? So you're a little bit outside that, so that's why you have a higher percentage chance of being correct. So you can click on leg, and you can see the actual positions of the individual legs, okay? Don't worry if you can't get it right on the line. That just means it's falling at a funky number, so just go to as close as you can. Okay, so look, you have a 77% chance of being right. You can actually choose and actually pick your odds of winning, which is what I love about selling options the Tasty Trade way. Okay, so let's review again. You're selling a naked put at $187, which means you're betting that the stock will stay above 187. You're also selling a naked call at $210, which means you're betting it'll stay below $210. Since you're doing both, you're collecting money. So you're going to collect a total of $1.39 from both sides. Okay? So, which means is at the end of 61 days, if the stock is anywhere in the green, you're going to collect somewhere, you're going to make money. Where's the ideal spot? You want to stay in this high peak area. See this right here? This is the chunk. You really want the stock to stay right around this level to collect the most money. If it goes to any of these outer levels over here, you're not going to lose money, but you're not going to make money. You're not going to make as much money either. You make break even. Okay, these are break even points. Now, if you want to know a little bit more detail, you click this center right here, and here's what comes up. Okay, you're selling a strangle. Here's your dates. So the most you can make is $130, and technically your max loss is unlimited. Okay, because it could go all the way over here and it could go all the way out here. Okay, now if you want to know what the chances of that are, just look at the 1 standard deviation line. It has less than a 5% chance of going past this line on either side. Okay, but right now I kind of want you to grasp the concept of what you're trying to accomplish here. So selling a strangle means, hey, you don't have a bias on which way you think the stock will go. You don't know if it's going to go up. You don't know if it's going to go down. But hey, you know, hey, that it has a 77% chance of staying within this range. That's a pretty good bet, and you're going to collect $1.39 to do it. Okay, and that's basically part 3, selling a strangle. This, by combining these two, this is the foundation for golden gecko trading. Okay. Now, one thing to note: you cannot do this in an IRA account. The rules don't let you do it. So in part 4, I'm going to cover how you can do that, because these are all naked. So we're going to have some defined risk trades after in part 4 and on. But I wanted to recap, okay, on what is selling a strangle. Okay, so repetition is the mother of all learning. Okay, so I'm going to clear this, and we're going to start from the beginning. Okay, what is selling a put? Selling a put, you're making a bet that the market will go higher. What does that look like? Go to options, click on short put. All this should remain the same. Okay, click on go. You're selling a put means you're betting that the market will go up. Where do you sell a put? Always 1 standard deviation out of the money. When selling a put, in this case, it means selling it below the current market price, which means you have at least an 84% chance of being right. Okay, and you can adjust it to right along that blue line, and we're pretty much real close. Okay, so the green area is where you're going to make money. The red is where you're going to lose. This is a bullish position, meaning you think that the market will go higher, the stock will go higher. The opposite of selling a put is selling a call. Choose strategy, go to option, click on short call, 45 days expiration. You want to make sure the monthly is checked. Click on 1 standard deviation again, and click on go, and here you go. Okay, now sometimes it's going to be like this. This is good. See, all you want to do is you want to drag it as close to that 1 standard deviation line, this blue vertical line here, as close as you get, it'll land on. That's as close as you're going to get. 86% chance of being right. Okay, that means you're betting that the market will stay below $210 in this case. Okay, now if you have no bias and you don't know if it's going to go up or down, what can you do? Sell a strangle, which means you're going to sell both at the same time. Go to choose strategies, go to strangle, click on short strangle, 45 days to expiration, make sure the monthlies are checked. You're going to click on 1 standard deviation, and you're going to click on go. This is your bread and butter trade. You you will have at least a 68% chance of being right, and you can tweak it to a percentage you feel most comfortable with. Okay, so here we go. Anything in the green, now as long as the stock stays in this green range, you're golden. Anything outside, you don't want. Okay, so again, you're selling a put at 1 standard deviation out of the money, which is below the current price. You're selling a call as close to this 1 standard deviation out of the money, which is which is above the current trading price. And here's your profit. You have a 77% chance of making up at least 1 penny, and you're collecting $1.39. Now, how do you manage your winners? Again, when you I'll go on that. We'll go through placing a trade in a coming video, but this is what you need to know. This is your foundation. Once you grasp this, and especially these next 3 segments, first 3 segments, you're good to go with your golden geckos and starting to place trades and doing quite well for yourself. Okay, well, that's part 3. Any questions, just let me know. Thanks for listening.